You have spent the last 4 episodes learning what school never taught you about money. Today, we tie it all together and build your complete financial plan from where you are right now to financial independence. Welcome back to Wealth Can Do. This is part 5, the final episode of our financial literacy series. What school never taught you about money? If you have not watched parts 1 through 4, stop right now. This episode assumes you understand everything from the previous parts. Part 1 covered money, income, and expenses. Part 2 covered banking, credit, and debt. Part 3 covered investing and compound interest. Part 4 covered taxes and keeping more money. Part 5 brings it all together. Links to all previous parts are in the description. Watch them in order. This is a complete course. For those of you who have been following along, congratulations. You have made it to the final episode. You now have more financial knowledge than 95% of people. Today we create your personalized financial plan. By the end of this video, you will have everything you need to take control of your financial future. This will be divided into 5 lessons. Lesson 1. The exact order of money priorities. Lesson 2. How to set financial goals that actually work. Lesson 3. How to build wealth on any income. Lesson 4. How to create your path to financial independence. And finally, Lesson 5. How to execute the plan over the next 5, 10, 20, and 30 years. This is part 5, building your financial future. Let's finish what we started. Lesson 1. The hierarchy of money priorities. What to do first, second, and third. Most people approach money randomly. They save a little. They invest some. They pay down debt when they feel like it. There is no strategy. No plan, no priority order. This is why they fail. Money needs a system. A priority order. Do this first, then this, then that. Here is the exact order. Follow it step by step. Do not skip steps. Do not do step 5 before step 1. Every financial advisor and expert agrees on this order. Step 1. Build a $1,000 emergency fund before anything else. $1,000 in a savings account. This is your buffer against life. If your car breaks down or there is a medical bill or an unexpected expense, $1,000 will cover most of such emergencies without going into debt. Save $200 per month. You will have it in 5 months. This is priority number 1. No investing, no extra debt payments. Just $1,000 in the bank. Step 2. Get employer 401k match. If your employer matches your 401k contribution, contribute enough to get the full match. This is free money. If they match 50% up to 6% of salary, contribute 6%. That's an instant 50% return plus tax deduction. Never leave this on the table. Step 3. Pay off high-interest bad debt. Credit cards at 24% APR. Payday loans, personal loans, over 10%. Any debt over 7% interest needs to die. Throw every extra dollar at this until it's gone. You cannot build wealth while paying 24% interest on debt. Impossible. Step 4. Build 3 to 6 months emergency fund. Once bad debt is dead, build a real emergency fund. 3 to 6 months of essential expenses. If you spend $3,000 per month, save $9,000 to $18,000. This is your insurance against job loss, medical emergency, major car repair. This is what keeps you from going back into debt. Step 5. Max Roth IRA. $7,000 per year in 2026. $8,000 if you're 50 plus. It's tax-free growth forever. This is the single best retirement account for most people. Max this every single year without fail. Step 6. Max 401k. $23,500 per year in 2026. $31,000 if you're 50 plus. It is a huge tax deduction, plus it has a compound growth. Employer match already captured in Step 2. Now max the rest. Step 7. Max HSA if eligible. $4,300 for individuals or $8,550 for families in 2026. This has a triple tax advantage. The most tax-efficient account available. If you have a high-deductible health plan, max this. Step 8. Pay off moderate interest debt. Car loans at 5%. Student loans at 4%. Mortgage at 3%. This debt is not urgent, but still costs money. If your mortgage is 3% and stocks return 10%, mathematically you should invest. But some people prefer the peace of mind of no debt. Your choice at this step. Step 9. Invest in taxable brokerage. If you have maxed everything above, you are investing $34,800 per year on 401k plus Roth IRA plus HSA individual. Anything beyond that goes into a regular taxable brokerage account. Keep buying index funds. Step 10. Build wealth and optional goals. House down payment, kids' college fund, real estate investing, or even business investments. This is where you customize based on your goals. This order is not random. It is designed to maximize returns while managing risk. $1,000 emergency fund first prevents going back into debt. Employer match next because it's free money. High interest debt next because 24% interest destroys wealth. Full emergency fund next for protection. Roth IRA next for tax-free growth. 401k next for tax deductions. HSA next for triple tax advantage. Moderate debt next for flexibility. Taxable brokerage next for unlimited investing. Every step builds on the previous step. You cannot do step 9 while still on step 3. You will fail. Most people fail because they skip steps. They invest in stocks while carrying credit card debt. They save for a house down payment while having no emergency fund. They max their 401k while not getting the employer match. Follow the order. Do not skip. Every step matters. Example of what this looks like on a $70,000 salary. Year 1. Build $1,000 emergency fund. Get 401k match. Pay off $8,000 credit card debt. Year 2. Build $12,000 emergency fund, 4 months expenses. Year 3. Max Roth IRA at $7,000. Start increasing 401k. Year 4. Max 401k at $23,500. Max Roth IRA at $7,000. Year 5 plus. Max everything. Invest in taxable brokerage. Build wealth. By following this order, you are financially secure and building massive wealth. Lesson 2. Setting financial goals that work. The SMART goal framework. Most financial goals fail because they are vague. I want to be rich. I want to save more. I need to invest. These goals are worthless. They have no deadline, no specific number, no accountability. Here is how to set goals that actually work. Use the SMART framework. Specific, not save money. Instead, save $15,000 for emergency fund. Measurable, not invest more. Instead, invest $500 per month in VU. Achievable, not become a millionaire in 2 years. Instead, build $100,000 net worth in 8 years. Relevant, goals must align with your priorities. Do not save for a $50,000 car if you need an emergency fund. Time-bound, not someday. Instead, by December 31st, 2027, bad goal, I want to get out of debt. SMART goal, pay off $15,000 credit card debt by December 31st, 2027. By allocating $1,300 per month to debt payments. Bad goal, I want to retire early. SMART goal, reach $1.5 million invested by age 55, by maxing Roth IRA and 401k annually for 25 years, starting at age 30. Bad goal, I need to start investing. SMART goal, open Roth IRA by February 28, 2026. Contribute $583 per month automatically. By VTI, reach $7,000 contributed by end of year. Write down your goals in SMART format. Make them specific, measurable, achievable, relevant, and time-bound. Break your financial life into 3 time frames. 1 year, 5 years, 10 years. 1-year goals 2026. These are tactical. Specific actions you will complete in the next 12 months. Save $1,000 emergency fund by March 31st. Pay off $5,000 credit card by August 31st. Max Roth IRA $7,000 by December 31st. Increase 401k contribution to 10% by June 15th. Read 3 personal finance books by December 31st. 5-year goals 2026 to 2030. These are strategic major financial milestones. Net worth $100,000 by 2030. Emergency fund 6 months expenses $18,000 by 2028. Zero consumer debt by 2027. Maxing 401k and Roth IRA annually by 2029. Down payment for house $40,000 by 2030. 10-year goals 2026 to 2035. These are aspirational. Big picture wealth building. Net worth. $500,000 by 2035. $400,000 in retirement accounts by 2035. Mortgage paid off or rental property acquired by 2034. Increase income 100% from $70,000 to $140,000 by 2033. Financial independence option available by 2035. Write these down. Review them quarterly. Adjust as needed. Goals guide decisions. When you're deciding whether to buy something, ask, does this help me hit my 1-year goals? My 5-year goals? If not, do not buy it. Lesson 3. The complete financial plan. Cash flow and budgeting. Everything starts with cash flow. Money in, money out. The difference is what you can save and invest. From part 1, you learned the 50-30-20 rule, 50% on needs, 30% on wants, and 20% on savings and investing. Track your spending every month. Know where every dollar goes. Use Mint, YNAB, or a spreadsheet. If you do not track spending, you cannot control it. Automate your savings and investing. Pay yourself first. Money hits your checking account. Automatic transfers pull 20% to savings and investing immediately. You never see it. You never miss it. Your money should be organized into specific accounts with specific purposes. Checking account for bills and monthly expenses. Keep 1 month of expenses here. High-yield savings account for emergency fund. 3 to 6 months of expenses. Earns 4 to 5% interest. You can use Ally, Marcus, or American Express. 401k. Employer-sponsored retirement. Contribute at least to match. Ideally max $23,500 in 2026. Roth IRA. Individual retirement account. Max every year. The maximum is $7,000 in 2026. You can use either Fidelity, Vanguard, or Charles Schwab. HSA, health savings account if eligible. Max, if you have high deductible health plan. The maximum is $4,300 for individuals in 2026. And finally, taxable brokerage. Move to this after maxing tax-advantaged accounts. The contributions are unlimited. Buy index funds. Your allocation across accounts depends on your age and risk tolerance. I personally prefer the following allocation depending on your age. Age 20 to 30, 90% stocks, VTI, VU, and 10% bonds. Maximum growth, long time horizon. Age 30 to 40, 85% stocks and 15% bonds. Still aggressive since you still have decades until retirement. Age 40 to 50, 80% stocks and 20% bonds. This ensures balanced growth and stability. Age 50 to 60, 70% stocks and 30% bonds. This reduces risk as retirement approaches. Age 60 plus, 60% stocks and 40% bonds. This allocation will preserve wealth and still generate income. This is just a general guidance. You can adjust based on your risk tolerance and goals. The plan only works if you execute it. Execution requires 2 things. The first thing it requires is automation. Set it once, it runs forever. No willpower needed. I personally prefer the following automations. 1. Automatic 401k contribution from paycheck. Set to at least employer match percentage. Increase 1% per year. 2. Automatic Roth IRA contribution. $583 per month on the first of every month from checking to Roth IRA. 3. Automatic HSA contribution. $358 per month if eligible. 4. Automatic emergency fund contribution. $300 per month until you hit 6 months expenses, then redirect to investing. 5. Automatic index fund purchase. Set your IRA and brokerage to automatically buy VTI or VOO every month. Automation removes the decision. It happens whether you feel like it or not. This is how you build wealth. The second thing that execution requires is consistency. Do the same thing every month for 30 years. No stopping, no pausing, no market timing. Market crashes? Keep investing. You are buying on sale. Market booms? Keep investing. You are riding the wave. Recession? Keep investing. You are dollar cost averaging. The people who build wealth are not the people who make perfect investment decisions. They are the people who keep investing consistently for decades regardless of market conditions. $500 per month for 30 years at 10% is equal to $1,130,000. $500 per month for 29 years. Stop for 1 year during crash equals $1,028,000. 1 year of stopping costs you $102,000. Never stop, ever. Lesson 4. Building wealth on any income. Start with the low-income strategy. I only make $35,000 per year. I can't save or invest. Wrong. You can. Here's how. With a $35,000 salary, your take-home after taxes is approximately $28,000 per year, which is $2,333 per month. Let's apply the 50-30-20 budget. $1,167 on needs. Find cheap rent, roommates, and minimize car costs. $700 on wants, limited but not zero, and $467 on savings or investing, which is $5,600 per year. $467 per month invested at 10% for 30 years is equal to $1,058,000. You can become a millionaire on $35,000 per year. It requires discipline. It requires sacrifice. But it is mathematically possible. Prioritize the following. Build $1,000 emergency fund. Get any employer 401k match. Pay off debt. Then invest $467 per month in Roth IRA and 401k. Focus on increasing income. Use that 20% to build skills, get certifications, change jobs, or invest in side hustles. Your goal is to increase from $35,000 to $50,000 within 3 to 5 years. Then $50,000 to $70,000. Every income increase gets invested. Now let's go to the middle income strategy. $70,000 salary, the median U.S. household income. Take-home is approximately $52,000 per year, which is $4,333 per month. 50-30-20 budget, $2,167 on needs, $1,300 on wants, $867 on savings or investing, which is $10,400 per year. But if you push to 30-50-20, $1,300 on needs, which is aggressive, but doable, $2,167 on wants for a reasonable lifestyle, and $867 on savings or investing, jumps to $2,600 per month, which is $31,200 per year. $2,600 per month invested at 10% for 30 years is equal to $5,900,000. On $70,000 salary with disciplined spending, you can retire with $6 million. Prioritize the following. Get employer match, pay off debt, build emergency fund. Max Roth IRA at $7,000. Max 401k at $23,500, and invest remainder in taxable brokerage. Lastly, let's go to high income strategy, $150,000 salary. This is a high earner. Take home is approximately $100,000 per year, which is $8,333 per month. If you fall into lifestyle inflation, you will waste it on bigger house, nicer car, or even expensive vacations. You will save the same 20% and build the same wealth as someone making $70,000. You should actually use 15-65-20 instead. Allocate it as follows: 15% lifestyle, 65% investments, and 20% on growing your income. This is how it will look like. $1,250 on lifestyle per month, which is $15,000 per year. $5,417 on investments per month, which is $65,000 per year, and $1,667 on income growth per month, which is $20,000 per year. $5,417 per month invested at 10% for 30 years is equal to $12,300,000. On $150,000 salary, with extreme discipline, you retire with over $12 million, and likely reach financial independence in 15 to 20 years instead of 30. Prioritize the following. Max everything, 401k, Roth IRA, and HSA at $34,800. Invest the remaining $30,000 plus in taxable brokerage. Use $20,000 per year to build business or increase income further. The key at high income is avoiding lifestyle inflation. Keep expenses low, invest the difference. Let's start with understanding what financial independence is. Financial independence means your investments generate enough income to cover your expenses without you working. You are not dependent on a paycheck. You work because you want to, not because you have to. This is freedom. The math. You need 25 times your annual expenses invested. If you spend $40,000 per year, you need $1 million invested. If you spend $60,000 per year, you need $1,500,000 invested. If you spend $80,000 per year, you need $2 million invested. Why 25 times? The 4% rule, which states that you can safely withdraw 4% of your portfolio annually without running out of money. 4% of $1 million is $40,000 per year, forever. This is based on historical data. A portfolio of 60% stocks and 40% bonds has survived every 30-year period in history, at a 4% withdrawal rate. Now let's find out the timeline to financial independence. How long does it take to reach financial independence? Depends on your savings rate. Savings rate is equal to amount saved and invested divided by take-home income. If you save and invest 10% of your income, it will take you 51 years to financial independence. If you save and invest 20% of your income, it will take you 37 years. If you save and invest 30% of your income, it will take 28 years. If you save and invest 40% of your income, it will take 22 years. If you save and invest 50% of income, it will take 17 years. If you save and invest 60% of income, it will take 12.5 years. And if you save and invest 70% of income, it will take 8.5 years. The more you save, the faster you achieve financial independence. This is why the 15-65-20 formula is powerful. If you can save and invest 65% of your income, you can retire in about 10 years. Most people save 10 to 20% and work 40 years. High savers save or invest 50 to 65% of their income and retire in 10 to 17 years. What does the post-financial independence life look like? What do you do when you reach financial independence? You can retire, stop working completely, travel, participate in your hobbies, spend time with family, volunteer, or you can keep working. But now you choose work you love instead of work that pays. You can take risks, start a business, write a book, build something meaningful. Financial independence is not about not working. It is about choosing how you spend your time without money being the deciding factor. Most people who reach financial independence keep working in some capacity, but they work on their terms. No boss, no commute, no stress about money. This is the goal, not just wealth. We have covered 5 parts, a complete financial education. Everything school should have taught you, but didn't. Part 1, understanding money, income, and expenses. You learned what money really is, the difference between income and wealth, the 50-30-20 budget, and how to control your spending. Part 2, banking, credit, and debt. You learned how banks make money, how credit scores work, good debt versus bad debt, and how to use credit strategically. Part 3, investing and building wealth. You learned the difference between saving and investing, how compound interest works, why index funds beat stock picking, and how to build $1 million portfolio. Part 4, taxes and how to keep more money. You learned how tax brackets work, why the wealthy pay less, tax-advantaged accounts, and legal strategies to reduce taxes. Part 5, building your financial future. You learned the hierarchy of money priorities, how to set goals that work, your complete financial plan, building wealth on any income, and your path to financial independence. This is the education you deserved. Now you have it. Knowledge without action is worthless. You have the knowledge. Now you must act. This week, open a Roth IRA if you don't have one. Set up automatic contributions. Buy your first index fund. This month, write down your 1-year, 5-year, and 10-year financial goals in smart format. This year, follow the hierarchy of money priorities. Step 1 through Step 10. Start where you are. The next 30 years, stay consistent. Keep investing. Never stop. Build wealth. You can do this. It is not complicated. It is simple. It just requires discipline and time. Thank you for watching all 5 parts of this financial literacy series. You are now in the top 5% of the people who understand money and wealth building. School failed you, but you fixed it. You invested the time to learn. That is the first step to building wealth. If this series changed how you think about money, share it. Send part 1 to someone who needs it. Post about it. Help others learn what school never taught them. Subscribe to Wealth Can Do for more wealth-building strategies, investing education, and financial literacy content. Remember, the best time to start building wealth was 10 years ago. The second best time is today. Start today. Follow the plan. Build your financial future. You've got this.